Welcome back to the deep dive. Okay, so as we kick off this week, the markets, they kind of feel like they're holding their breath, don't they?
They really do.
We're poised right now between, really strong performance, S&P, NASDAQ, Q, near records, and maybe, just maybe, a pivot point.
Yes, interesting tension.
And it's all fueled by this surprisingly resilient labor market, and, well, everyone's hoping for that soft landing, right?
That's the big narrative, absolutely.
So with that setup, how do we decode the week ahead? It doesn't look like a flood of data.
No, it's not packed. It's more about pinpointing a few really pivotal moments, things that could genuinely swing sentiment.
Okay.
So for this deep dive, we've looked at a detailed market analysis report covering this week, July 7th to the 11th. It hits the macros, some early earnings, and importantly, monetary policy signals.
Gotcha.
And what's really striking, I think, is how delicately balanced that bullish feeling is right now. It means even a few key releases can have this, outsized impact.
Amplified effect.
Exactly. So our mission here is to help you understand the core debates, the things that'll define the next few days, so you can spot those aha moments, the insights that reveal the deeper trends.
Right. So even though it feels like a quieter week data-wise, there's this one critical moment brewing.
Mhm.
The release of the June 17th, 18th FOMC meeting minutes, that's Wednesday, July 9th. For a lot of people, this is the week's real pulse check.
It absolutely is.
The market, as you know, has pretty much priced in 2 rate cuts for 2025. That comes partly from the Fed's own dot plot, their projections. But why are these minutes, so pivotal right now? What are we really going to learn?
It's all about seeing behind the curtain, really. I mean, the dot plot gives you an average, right? An overview.
Yeah, the summary.
But the minutes,
Yeah.
they show the full debate, the disagreements, the nuances, and the market is going to go through these with a fine-tooth comb, looking for specifics.
For what specifically?
Well, first, the whole inflation debate. Are officials really feeling confident that inflation's heading back to 2%? Or are they still worried about it being, sticky? How embedded is it? That's been a big point of contention, and the minutes should show us who's leaning which way.
So it's not just the forecast, but how strongly they feel about that forecast?
Precisely. Then there's the conviction on rate cuts. Did a decent number of people actually argue for just one cut? Or maybe even no cuts in 2025?
Ah, okay.
If we see that, that would be a genuinely hawkish surprise, suggesting fewer cuts than expected. And that goes right against the market's current dovish read.
Which expects easier policy.
Exactly.
Yeah.
And finally, just the language used, the emphasis. Is it on downside risks to growth? That's dovish, suggests they're worried about a slowdown, might cut sooner.
Right.
Or is the focus on upside risks to inflation? That's hawkish. Means they're still laser focused on prices. So the big question this raises is, does this raw discussion in the minutes back up the market's optimism, the whole soft landing story?
Or contradict.
Or contradict it? And that's where we could see a pretty significant repricing of interest rates. Bond yields move, stocks react.
Okay, that potential for repricing definitely makes the minutes the main event. But what if they're kind of ambiguous? What else is out there this week that could nudge things, even if it's maybe second-tier stuff?
Yeah, even that second-tier data can give us some really useful signals, especially when you put it all together. So Monday, July 7th, we get the consumer credit change for May.
Right, borrowing, credit cards, auto loans.
Exactly, excludes mortgages.
Oh.
So if that number comes in way above the consensus, which is around $10.5 billion,
Suggests people are confident spending.
yeah, reinforces the soft landing idea. But if it's much lower, it might hint at some financial strain, consumers pulling back. That could worry people about future spending.
Makes sense. A little window into household budgets.
Okay.
Okay, then Tuesday, July 8th, we've got the NFIB Business Optimism Index. Small businesses. Why is this one so critical?
It's huge because these small and medium businesses, they employ roughly half the private workforce. So their mood is a massive barometer for the whole economy.
Wow, half. Okay.
We'll be looking inside the report, especially at what they say is their single most important problem. Apparently, there's been a recent shift. It used to be labor quality.
Finding workers.
Right.
Yeah.
Now it's leaning more towards taxes. And zooming out, that subtle shift could mean margin pressures are becoming a bigger deal than just finding staff. It's the very nuanced early sign when things are cooling off a bit.
Interesting. Less about hiring, more about costs and profits squeezing them. Also on Tuesday, consumer inflation expectations from the New York Fed. Why does the Fed care so much about what consumers think inflation will do, even if they're often wrong?
Yeah, they pay super close attention
Yeah.
because they worry these expectations can become, like, self-fulfilling.
Like how so?
Well, if everyone expects prices to keep soaring, they might demand bigger raises, right?
Yeah.
And businesses might feel okay raising their own prices because, hey, everyone expects it. It could create this feedback loop.
Ah, okay.
The one-year expectation actually dropped recently to 3.2%, which was good news. So if we see that tick back up this week, that would be a hawkish signal for the Fed. Might make markets nervous right before those FOMC minutes drop.
Because it suggests the Fed's inflation fight isn't quite won in people's minds yet.
Exactly. Or that maybe underlying pressures are just still too strong.
Okay, so Fed minutes, consumer mood, business outlook. Now let's talk weekly jobless claims on Thursday the 10th. Initial claims, the new layoffs, they've been pretty low, right? No signs of massive job cuts yet.
Correct. Generally holding steady.
But here's where it gets interesting, maybe even a bit telling. The continuing claims. The number of people collecting benefits for more than a week. That number recently hit its highest point since, what, late 2021?
Yeah, November 2021.
So what's that divergence telling us? Low initial, high continuing.
It's really crucial for you to grasp this because it gives a much more nuanced picture than just the initial claims. Low initial filings suggest companies aren't doing widespread firings. Good. But rising continuing claims suggest that people who do lose their jobs are finding it harder to land a new one. They're staying unemployed for longer.
Okay, so the churn is slowing down.
Precisely. Connect that to the bigger picture, and it's a pretty clear signal of a subtly cooling labor market, which actually could give the Fed a bit more room to cut rates later on if it fits their goals. It shows rebalancing, but maybe not super fast.
Got it. Okay, so shifting gears from macro data. Q2 earnings season starts to trickle in this week. Just a trickle, but some important early clues, right?
Definitely. These first ones are like bellwethers.
We're watching a few key names on Thursday, July 10th. First up, Delta Airlines. DAL, first major airline out the gate. Why is this one so important?
Well, airlines are a great barometer for spending on services, both by consumers and businesses. With Delta, the market's going to be absolutely laser-focused on the mix of demand.
Meaning?
Are premium seats selling well? Is corporate travel bouncing back strongly? If yes, that points to a healthy high-end consumer and businesses feeling confident enough to spend on travel.
And their outlook for summer travel will be huge.
Oh yeah. Delta's guidance sets the tone for the whole travel sector. It's fascinating because it really tells you about the health of that higher income bracket.
Yeah.
But if they mention companies pulling back on travel,
That's a warning sign for the broader economy.
exactly, a negative leading indicator for business activity, potentially.
Okay, then we switch gears to Conagra Brands, CAG.
Right.
Totally different end of the consumer spectrum, right?
Completely. Conagra gives us that snapshot of middle and lower income households, people more sensitive to everyday costs.
So what's the main question for Conagra and maybe for all consumer staple stocks right now?
It's really about pricing versus volume. Are shoppers starting to push back against higher prices? Are they buying less, trading down to store brands?
Resisting the price hike?
Yeah, we need to hear their commentary on input costs too, of course.
Yeah.
But fundamentally, are everyday shoppers having to tighten their belts? That's the core issue.
And just to add a bit more color to that consumer picture, we also get Helen of Troy, think OXO, Hydro Flask, and Simply Good Foods Atkins Quest bars.
Right. Helen of Troy tests spending on, non-essential stuff, discretionary goods. How resilient is that?
Yeah.
And Simply Good Foods tells us if people are still willing to pay a premium for wellness.
Okay, so let's put these pieces together. Imagine a scenario. Delta reports really strong results, especially high-end travel. But Conagra comes out and says volumes are weak, people are trading down. What does that tell us overall?
Well, that paints a pretty compelling picture of what people call a K-shaped economy.
K-shaped. Explain that.
Yeah, it basically means a split. Different income groups having totally different experiences. The top part of the K is going up, the affluent are doing well, spending. The bottom part of the K is going down lower, and middle-income folks are struggling, cutting back.
Ah, I see. Diverging paths.
Exactly. So strong Delta, weak Conagra.
Yeah.
That's powerful evidence of that split. And connecting that to the bigger picture, well, that K-shaped outcome has real implications for your portfolio strategy. You might favor companies serving the affluent over the mass market, for example.
Definitely impacts which consumer stocks look more attractive. Okay, so let's bring it all home. With the Fed minutes, the labor data nuances, these early earnings, what's the potential market impact? S&P 500, NASDAQ Q this week. Let's game out the scenarios. What's the Goldilocks outcome look like?
Okay, the bullish scenario, the Goldilocks one,
Yeah.
that would be FOMC minutes that are seen as dovish or at least not hawkish. So the Fed sounds comfortable about eventual rate cuts.
No nasty surprises there.
Right. Combine that with stable, maybe slightly softer consumer data and strong earnings from Delta, showing that high-end spending is solid. That whole package would be like an all-clear signal. Could definitely push the S&P and NASDAQ Q higher, maybe even to new records. Really validates the soft landing story.
Okay, makes sense. And the flip side, what triggers a bearish move?
Well, the opposite, basically.
Yeah.
Undeniably hawkish minutes. The Fed sounds more worried about inflation, less keen on cutting rates soon.
Uh-oh.
Add in a worrying jump in those continuing jobless claims, hinting the labor market is cracking more than we thought, and then weak earnings from consumer names like Conagra. Put that mix together.
Risk off. Sell first, ask questions later.
Pretty much, that would spark a significant risk-off move, and the rate-sensitive NASDAQ would likely get hit particularly hard because higher rate expectations hammer growth stocks.
Got it. So for listeners thinking about specific sector and industry sensitivity, tuning their strategy, where should they focus their attention this week?
Okay, a few key areas to watch. Tech and growth, your XLK, QQQ ETFs, they are super sensitive to how those FOMC minutes land and what happens with Treasury yields afterward. A hawkish Fed is a major headwind there, period.
Because higher rates hit their valuations harder.
Exactly. Then look at the difference between consumer discretionary XLY and consumer staples XLP. That's going to be driven heavily by those earnings reports we talked about. That K-shaped outcome, strong Delta, weak Conagra, would probably see XLY outperform XLP because the high end keeps spending on wants, not just needs.
Interesting dynamic. What about financials, industrials?
Financials XLF are tricky. They're sensitive to the yield curve. A hawkish surprise might steepen the curve, which helps bank profit margins.
Well, good for banks.
But it could also ramp up fears of a hard landing, which is bad for loan growth and credit quality. So it's a bit of a double-edged sword there.
Okay.
And finally, industrials, XLI. They'll be watching Delta's comments on corporate spending and also that NFIB survey for clues about capital expenditure plans. Weakness in either suggests businesses are getting cautious, pulling back on investment. That's a negative sign for future industrial activity.
All right, so boiling it down, key risks and opportunities this week. What is the single biggest risk, the thing that could really derail this market?
Look, the single greatest risk, I think, is that those FOMC minutes show a Fed committee that is way more worried about inflation and way less committed to cutting rates in 2025 than the market currently believes.
More hawkish than priced in.
Much more. That wouldn't just be a small adjustment. It would force a rapid repricing of rate cut odds, spike Treasury yields, hammer growth stocks, and basically challenge that whole soft landing narrative that's been propping things up. It would be a real jolt.
That's definitely the downside scenario to watch. But okay, flip side. What's the biggest opportunity? Where's the potential upside surprise?
The biggest opportunity is simply getting that Goldilocks confirmation we talked about.
Yeah.
No hawkish bond shells from the Fed. Consumer data that's stable or maybe softens just enough to ease inflation fears. And strong high-end earnings, like from Delta, if you get that combo.
It validates everything.
It could absolutely validate current valuations, cement that soft landing view, and give the market fuel for another leg up, maybe push us to new highs. It would be the confidence boost investors seem to be looking for.
What a week. It feels quiet on the surface, but underneath, wow. Just a few data points, a couple earnings reports, holding so much weight, especially the Fed's tone and how different consumers are actually behaving.
Yeah, this week's deep dive really underscores how even when the calendar looks light, the market is always recalibrating, always adjusting expectations. So as you process all this, think about not just what the data says, but how it lines up or maybe doesn't line up with what's already priced in.
Right, the gap between expectations and reality.
Exactly. The real nuggets of knowledge, the actionable insights, often lie in understanding that delicate balance, that perception versus reality in the markets.
Well, we've definitely unpacked a lot today, hopefully giving you that shortcut to being really well-informed for the week. If you want to keep getting these kinds of critical insights, stay ahead of the curve with the fastest, most frequent updates we can offer, definitely make sure you hit that subscribe button.
Yeah, please do.
We're here to help you make sense of it all, one deep dive at a time.